Welcome to Delphos Insights. I'm here today to discuss what's being called a structural transformation in infrastructure finance, particularly in emerging markets. The numbers we're seeing are quite remarkable.
They really are. We've documented $48 billion in infrastructure fundraising just in the first quarter of 2025. What strikes me most is how this represents a fundamental shift in how institutional investors view these assets.
You're referring to Bart Turtleboom's observation that infrastructure is becoming the backbone of resilience rather than a secondary consideration?
Exactly. The traditional view of infrastructure as a stable but unremarkable asset class is being completely rewritten. We're seeing investors actively seeking exposure to emerging market infrastructure because of the growth potential and the structural trends driving demand.
Let's break down what's driving this transformation. From my research, I've identified 5 key trends that are reshaping the entire landscape. The first is quite fascinating. It's the mainstream adoption of blended finance structures.
Blended finance has been revolutionary. Can you explain how it's changing project viability for our listeners?
Certainly. The mechanism works by combining development finance institution capital with private investment. The development institution essentially provides a risk cushion through first loss provisions or guarantees, which dramatically improves the risk-return profile for commercial investors.
And the scale of this is significant. Our data shows development finance institutions are now co-financing approximately 30% of all private infrastructure deals in low and middle-income countries. That's substantial institutional backing.
The Emerging Africa Infrastructure Fund exemplifies this perfectly. They've successfully financed solar installations and grid expansions across the continent, projects that would have been considered too risky for conventional financing just a few years ago.
Which brings us naturally to the second major trend, the mainstreaming of green bonds and sustainable financing. The growth here has been exponential.
The statistics are striking. Global clean energy investment reached nearly $2 trillion in 2024. In Asia alone, we're projecting green bond issuance to exceed $1.1 trillion by 2025. This isn't niche anymore.
What's particularly interesting is how this strong demand is affecting terms. Emerging market issuers are securing longer maturities and lower rates because institutional investors are competing for access to these instruments.
And we're seeing innovation in the instruments themselves. Sustainability-linked bonds are gaining significant traction, where the issuer's cost of capital is directly tied to achieving specific environmental targets.
The financial performance validates this approach too. Listed green infrastructure outperformed global equities by 660 basis points over the past 12 months. Sustainable investing is proving to be profitable investing.
Connecting, that performance leads into our third trend, the redefinition of infrastructure through digitalization. Data centers have become critical infrastructure assets, capturing 25% of all infrastructure capital allocations this quarter.
This creates interesting challenges, though, doesn't it? Particularly around power requirements in emerging markets where grid reliability can be inconsistent.
Absolutely. What we're seeing is developers integrating renewable power generation directly into data center projects. Solar arrays, battery storage systems, it's creating a convergence where digital infrastructure demand is actually accelerating clean energy investment.
Brazil, Kenya, and India are excellent examples of this integration. New facilities are being designed with renewable power systems from the ground up, supporting both digital transformation and energy transition simultaneously.
As we look at projects like TESA, we can see that when digital infrastructure meets energy transition, innovation and efficiency become the keys to unlocking new possibilities. The fourth trend involves the evolution of public-private partnerships toward more sophisticated structures. Traditional models are being replaced by outcome-focused frameworks.
The availability-based model is particularly effective. Instead of payments based on usage, compensation is tied to uptime and quality metrics. This aligns public and private sector incentives much more effectively.
And there's a policy dimension here that's crucial. Each significant regulatory reform can unlock up to $450 million in additional private investment. The regulatory environment is as important as the financial structuring.
Which connects to our fifth trend, local currency financing. This addresses what has historically been a major vulnerability in emerging market infrastructure projects.
The foreign exchange mismatch problem. Projects earning revenue in local currency but financed in hard currency face significant risk if the local currency weakens.
Exactly. The solution is currency matching, financing projects in the same currency they generate revenue. The International Finance Corporation and African Development Bank are leading this approach with local currency loans and guarantees.
Colombia's peso toll finance toll roads and Nigeria's naira-denominated power projects demonstrate how this creates more stable cash flows while strengthening domestic capital markets.
The convergence of these five trends, blended finance, sustainable instruments, digitalization, evolved partnerships, and local currency financing, is creating unprecedented opportunities in emerging market infrastructure.
What's remarkable is how these trends reinforce each other. Digital infrastructure drives renewable energy demand, which attracts green finance, which benefits from blended structures and local currency financing.
For institutional investors, this represents access to high-growth markets with sophisticated risk management tools and strong regulatory support. The investment case has never been more compelling.
As we consider these developments, here's a question worth pondering. How can emerging markets balance the urgent need for digital infrastructure expansion with their commitments to sustainable energy transition, given the power-intensive nature of data centers?
That's the central challenge of our time in infrastructure development.
This has been Delphos Insights. Learn more at delphos.co.